This question tests the distinction between economic costs and accounting costs, an important concept in economics, finance, and managerial decision-making. Accounting costs are the explicit costs recorded in a company's financial statements. These include expenses such as wages, rent, utilities, depreciation, interest, and taxes that involve actual cash payments or recognized accounting expenses. In contrast, economic costs include both explicit costs, recorded accounting costs, and implicit costs, opportunity costs, which represent the benefits sacrificed by choosing one alternative over another. For example, if a corporation uses its own building for operations instead of renting it to another company, the foregone rental income is an opportunity cost. Although no cash transaction occurs and nothing appears in the financial statements, it is an economic cost because the company sacrifices an alternative benefit. Therefore, the primary difference between accounting costs and economic costs is the inclusion of opportunity costs, which are excluded from financial accounting but are essential for evaluating economic performance and decision-making.
A. Interest costs. Incorrect.
Interest expense is an explicit accounting cost and is reported in the financial statements. B. Salary and wage costs. Incorrect. Salaries and wages are explicit costs that are recognized as operating expenses.
C. Opportunity costs.
Correct. Opportunity costs are implicit costs representing foregone alternatives. They are included in economic costs but are not recorded in financial statements. D. State and local tax costs. Incorrect. Taxes are explicit expenses and are reported in accounting records. Correct answer, C. Opportunity costs. Key takeaway: the major difference between economic costs and accounting costs is that economic costs include opportunity costs, which represent the value of foregone alternatives. Because these implicit costs are not recorded in financial statements, economic profit is often lower than accounting profit and provides a more comprehensive measure of business performance. This question tests the definition of economic profit, a key concept in economics and managerial finance. Students should distinguish economic profit from accounting profit, as the two measures use different definitions of cost. The formula for economic profit is economic profit equals total revenue dash explicit costs dash implicit opportunity costs. Explicit costs are actual out-of-pocket expenses incurred by the business, such as wages, rent, raw materials, utilities, depreciation, and interest. Implicit costs, opportunity costs, represent the value of resources owned by the business that could have been used in the next best alternative. Examples include the owner's foregone salary or the return that could have been earned by investing capital elsewhere. Unlike accounting profit, which subtracts only explicit costs, economic profit subtracts both explicit and opportunity costs. Therefore, economic profit measures whether a business is earning more than the total economic value of the resources it employs.
A. Variable costs.
Incorrect. Variable costs are only one component of explicit costs and ignore fixed and opportunity costs.
B. Recurring operating costs.
Incorrect. These include only regular operating expenses and exclude opportunity costs.
C. Fixed and variable costs.
Incorrect. Fixed and variable costs together represent explicit accounting costs but do not include implicit opportunity costs. D. Opportunity and explicit costs. Correct. Economic profit is calculated by subtracting both explicit costs and opportunity, implicit costs from total revenue. Correct answer, D. Opportunity and explicit costs. Key takeaway: economic profit equals total revenue minus all explicit and implicit opportunity costs. By including the value of foregone alternatives, economic profit provides a more comprehensive measure of business performance than accounting profit and helps determine whether resources are being used in their most valuable way. This question tests the concept of economic cost, which includes both explicit costs and implicit opportunity costs. It is a fundamental concept in economics and managerial finance and differs from accounting cost. The formula is economic cost equals explicit costs plus opportunity costs. Explicit costs are actual out-of-pocket expenditures, such as tuition, books, fees, and living expenses directly associated with attending school. Opportunity costs represent the income or benefits foregone by choosing one alternative instead of another. In this case, Williams gives up his annual salary of $35,000 by leaving his accounting job to pursue an MBA full-time. Students should recognize that the foregone salary is an implicit cost, even though it does not appear as an accounting expense. Economic analysis includes this sacrificed income because it reflects the true cost of the decision. Calculate the annual economic cost. Explicit costs equals $25,000 opportunity cost, lost salary, equals $35,000 inch economic cost equals $25,000 plus $35,000 equals $60,000. Thus, the total annual economic cost of pursuing the MBA is $60,000.
A. $10,000. Incorrect.
This incorrectly subtracts tuition from salary rather than adding explicit and opportunity costs. B.
$35,000. Incorrect.
This includes only the opportunity cost of lost salary and ignores tuition and other expenses. C.
$25,000. Incorrect.
This includes only explicit educational costs and ignores the foregone salary.
D. $60,000. Correct.
Economic cost equals $25,000 of explicit costs plus $35,000 of opportunity costs, totaling $60,000.
Correct answer, D. $60,000.
Key takeaway: economic cost includes both explicit expenditures and opportunity costs. When Williams leaves his $35,000 job and incurs $25,000 of educational expenses, the total annual economic cost of obtaining the MBA is $60,000, representing the full economic sacrifice of his decision.